This is John Martinka, and I want to talk about creative finance in buy-sell transactions. First of all, let me define what creative finance is not. It is not financial hocus pocus or wishful thinking. It is using the assets and or the cash flow of the business to help pay for the business. Let me give you some examples, and let me start with some that really aren't deal specific. These days, the SBA loan guarantee program is easy money for buyers and helps sellers tremendously. There are programs such as Guidant Financial in Bellevue, Washington, and allow business buyers, as well as franchise buyers and startups, to use money in their retirement program without paying tax or penalty. But let's talk about some deal-specific examples of creative finance. Rob bought a company where the seller loved assets, loved seeing full racks of stuff. Rob came in and in just 1 year reduced the inventory by $200,000. That turned to cash on his balance sheet just through better inventory management. Now this particular seller also loved, I should say adored, big trucks. The business didn't need a big truck. The business needed a small truck, so Rob sold the big truck, pocketed the difference, and had lower operating costs after he bought a small truck. Buying, including some cash and accounts receivable in the deal. In smaller transactions, it's typical that cash and accounts receivable were never included in the deal. Lately, more and more that working capital is staying in the business. Banks love it. They love to see the buyer start out with a strong balance sheet. Makes the deal similar to larger deals where working capital is a given that it will stay in the company. There can even be creative financing with debt. One of my clients came to me once and said, "The bank's not being very creative with me." Now my answer was, the bank's not in business to be creative. They're in business to be paid back. That said, his bank was offering him a 5-year note with a 7-year amortization and first-year payments the equivalent of a 12-year amortization because they knew he needed good cash flow his first year in business. On top of that, his seller offered a 5-year interest-only note. These days, new SBA rules, there's a lot of creativity with banks. The banks will set the rules, but it's a lot more creative.